Okay, good evening, everyone. You are welcome to our online class. We are going to pick it up from where we stopped the last time. Sorry for starting a little bit late. I just have to be sure that things are really in order. Can somebody please confirm you can hear me before we start? So just help me to quickly confirm that you can hear. All right, thank you very much for the confirmation. Thank you very much for the confirmation. We are going to, okay, sorry. We are still going to take it off from where we stopped. We have IAS12 before us this evening, and hopefully we should be able to deal with it. If time will permit us, I'll bring us around IAS19 as well. And that's employee benefits, okay? I will do that very shortly. So, but let's start with IAS12, income taxes. And obviously this standard is very important because sometimes it cut across, some other stuffs that we have learned. For example, group accounting, even some other standard like IFRS2 and all of that. So let's see the implication of deferred tax and on those scenarios, okay? So you're all welcome once again. So just try to sit back and listen to the lectures attentively. Okay, so income taxes is dealt with under IAS12, okay, under IAS12. That's where we have, income taxes, okay? Now, basically, we have two elements of tax. We have recurring tax and deferred tax. IAS12 really dealt with or deals with deferred taxation. Now, when you talk about the current tax, that's the amount payable to tax authority in a particular accounting year, okay? So let's say we are in 2021. How much am I going to pay? That means we've already agreed on that. So that is what we call deferred tax. Current tax, okay? Now, for deferred tax, that talks about the accounting measure that used to match the tax effect of transaction with the accounting treatment, okay? Now, so the issue here around deferred tax is that we're trying to match tax effect of transactions to their relevant accounting period. For example, let's say I sold on credit, okay? I sell some certain goods on credit. I've not really collected money. So when I collect money is when I'm going to pay tax. It could be in future periods, okay? However, I've already recognized it in my accounting or in my account this year. So I needed to recognize deferred tax in respect of those transactions so that I can match it with relevant accounting period, because it actually occurred this accounting period, even though I might likely have to pay the tax element in the future, okay? So that makes it deferred taxes, okay? So that's the issue and that. And normally you also know that what I just told you about is what we call the accrual concept, accrual concept of accounting, okay? So where you don't really need to wait for cash to be received before you recognize those transactions, okay? So in summary, the tax expense for the entity is now calculated as you look at the current tax, the movement in deferred tax, all right? So for me to know the current tax I'm going to pay, I need to, or my tax expense, I need to look at my current tax, maybe I've already agreed for that particular accounting period. Then I also look at movement in my deferred tax, because that deferred taxes will occur year in, year out. Is that okay? And how do I get that? We are coming there. Okay. Now, so when I have my current taxes, what do? I debit my tax expense and credit tax payable. Okay, so it goes straight into my profit or loss account. So that's why in many jurisdictions, they wait for, let's say, 6 months after the accounting period for you to remit your company income tax, because it requires a lot of adjustment into really getting the actual taxes that will be paid in that particular accounting year. Okay, so now when it now comes to my current tax, okay, so let me take a look at this. Current tax accounting is often based on estimates. So most likely I estimate the likely amount I'm going to pay, before the final amount is, finalized with tax authority. So if, for example, the eventual amount that I pay is less than the estimate, okay? So let's say I'm paying less than what I've estimated. That's what they call under provision, okay? So it's going to reduce my future tax expense in the next accounting period, okay? Let's say, for example, I estimated, what's it called? I estimated 500,000, for example, all right? So the amount I paid is now, let's say, 400, which is less than my estimate. And I estimated 500. So obviously, my future tax is going to be reduced, okay? And that's is there over provision, okay? Then if I pay more, I estimated 500 and I pay more, that means I under provide, okay? So that means my future tax expense is going to be increased. Okay, so that's what happens there. So you simply debit your tax expense and credit your tax payable, okay? Now, so let's now look at deferred tax, because obviously that is what is dealt with under IAS12, okay? Now, what really gives rise to deferred taxes? There's something we call accounting profit, right? There's something we call accounting profit. Accounting profit is you've done your transaction for a particular year, then you arrive at your profit. Then there's also something that we call taxable profit, okay? Now, when I compute my accounting profit, there are a lot of expenses that are not allowable, okay? They're already deducted from my revenue for me to get my profit. A lot of transactions would have happened that are not really allowable by the tax authority. So I have my accounting profit. So it's not possible that when I make those adjustments, probably I had back depreciation and what have you, then I have my taxable profit. So obviously it won't be the same, okay? So when you have difference between accounting standards, that for example, IFRS, which gives birth to your accounting profit, then the tax rule, okay? So what it means is there are going to be adjustments, okay? And some of those differences between the accounting and tax treatments might be permanent differences, okay? They are permanent. Once you have those differences between my accounting profit and the tax rules or tax base or tax authority, then I could have something they call permanent differences. For example, why is it permanent? That means there are some expenses that are disallowable, okay? So once I'm adding them back, they are permanent, okay? So for example, fines, political donations, and entertainment costs would have been expensed in the P&L, but are normally disallowed by tax authority. So therefore, these costs will have to be eliminated by adding them back, okay? So they are permanent differences. And some differences between accounting and tax treatment are temporal, okay, or temporary. They are not really permanent. For example, you have capital assets that might be written down at different rates for tax purposes than they are in the financial statement. So those are temporary differences. So temporary difference may mean that profits are reported in the financial statement before they are taxable, okay? So I've already reported those profits before they are taxable, which means that that tax is payable even though profit has not been reported, okay? Profit have not yet been earned or be reported in the financial statement, and they are already taxable. So it will give rise to temporary difference. Is that okay? Okay. And what gives rise to temporary difference now leads to what we call deferred taxes. So according to accrual base of accounting, for example, the tax effect. The tax effect of those transactions should be reported in the same accounting period when the transaction occurs, all right? So that tax effect, even though they have been reported, they are not yet taxable, okay? So the tax effect has to be reported in that account. Remember, I told you earlier that deferred tax is looking at matching the tax effect of transactions in relevant accounting period. Is that okay? So therefore, an adjustment will have to be made, all right? And that gives rise to deferred taxes, okay? Now, remember that deferred tax only arise on temporary difference, okay? It only arises on temporary difference, okay? And, when it comes to permanent difference, because it's already permanent, so you don't really have to do deferred taxes. So when there is temporary difference, they give rise to, what's it called? Deferred tax. So a temporary difference will now be the difference between the carrying amount of an asset or a liability and its tax base, all right? The temporary difference is a difference between the carrying amount of an asset or liability, the way accountants would have prepared it under IFRS, and tax base. What's tax base? Tax base is the amount attributed to an asset or liability for tax purposes, okay? So tax base is the amount attributed to an asset or a liability for tax purposes. So the taxman comes and says, this is our asset, this is the tax base, probably based on capital allowances and all of that, all right? But in your account, you have the kind amount, the costs and depreciation and all of that, all right? And obviously, sometimes you might have even claimed capital allowance in the year of purchase before you start charging depreciation, okay? So that will give rise to temporary difference, okay? Now, let's look at this illustration to demonstrate our understanding. Now, Prudent prepares financial statement to 31st December each year. On 1st January 2010 or 20X0, the entity purchased a non-current asset for 1.6 million and had anticipated a useful life of 4 years. The asset qualified for immediate tax relief of 100% on cost, immediate. So that means in year one. For the year ending 31st December 20X0, a draft account showed a profit before tax of 2 million. The directors anticipate that this level of profit will maintain into a foreseeable future. Prudent pays tax of 30%. Apart from the differences caused by the purchase of non-current asset in 20X0, there are no other differences between the accounting profit and the taxable profit or tax base and carrying amount of the net asset required. Compute pre and post profit for prudence for each of the 4 years ending December 20X0 to 20X3, inclusive, and for the period as a whole, assuming that no deferred tax is recognized. 2, that deferred taxes or deferred tax is recognized. Okay, so we're going to look at 2 scenarios here. If there is no deferred tax or if there is a deferred tax. So what do you do? Now, when I'm preparing this account and I'm not recognizing deferred tax, how does it look like? I simply bring my accounting profit. Is that okay? Now, if you look at that question, already told us that in the accounts, we have already recognized profit before tax, okay? And for me to get this profit before tax, I've charged a lot of non-cash items, disallowable expenses, and all of that. Although we're not really giving most of those information, but we know that depreciation will be added back, all right? So you bring on that profit for the year, okay? Then you add back depreciation. So we're told in the question that, let me be using the question here. I think I have it on the textbook here. It said, so that I won't be scrolling up and down. It said the entity purchased non-current assets of 1.6 and it anticipates 4 years useful life. Okay. Now, This asset qualifies for immediate relief of 100% of the cost. So that's the capital allowance. So you remove the capital allowance immediately in year one of purchase. So I have my taxable profit. That's quite straightforward, okay? Now I charge my tax, current tax at 30%. So most likely that is what I pay. That's what I'm going to pay, okay? So now, so the difference between the accounting profit and the taxable profit that will occur from year to year canceled out at the end of the 4 years, okay? So you could see that at the end of the 4th year, this will cancel out, okay? Now, you could see the taxable profit here, and by the time you add all of this together, it also give you that 2/4, so to cancel out. So my statement will now read, this is my current tax because I have to compute taxable profit. Remember, this is my accounting profit, what I've computed under IFRS. But a taxman will say, no, that is the accounting profit. For me, I need to add back depreciation so that I can increase that profit then before I apply the current tax rate in that particular region. Let's say 30%, okay? Okay, so I now bring back my current tax, okay? Can you see just what you got here? So that's what you are bringing into my profit before tax, so that I can have my profit after tax. That's the main issue here, okay? Now, here we have ignored deferred taxes, okay? So we didn't really recognize the deferred tax effect of those transactions. So that's why if you notice that ignoring deferred tax produces a performance profile that suggests declining performance. So if you notice, I recorded higher profit in the first year, okay? In the second year, it's declined, okay? Because I ignored deferred taxes. Now, in fact, the decline profit is caused by timing of current tax charge, okay? Now, how do I record this transaction if there's a deferred tax? So let's find out. Now, what's the current amount of this particular asset? If you look at the question, I bought this asset for 1.6 million, and I'm going to depreciate for 4 years. So I can press my calculator and say 1.6 divided by 4 is going to give me 400, okay? So it gives me 400 in year one. So if I remove 400 from 1.6 in year one, the current amount will be 1.2. Is that okay? I remove 400 again, the current amount here too will be 800. I remove the 400 again, I have 400 left, okay? I remove 400 again, I have 400. Then the last year, there's no longer, it's now 0, it's new, okay? Now, what's my tax base? It's going to be new, we're now told, right? Okay. Now, I have a temporary difference between my, current amount and the tax base. Okay. Now, so my closing deferred tax is going to be, I will now apply 30% on this particular amount. What we did earlier, we just go straight to the profit. But for me to look at the deferred tax effect, I need to bring on that particular asset. That's what we are taking a look into here. So we have the closing tax liability to be 360. So what do? We just apply 30% on the 1.2, okay? 30% on 800, you have 240. Then 30% on 400, you have 120. Then new, you have new. Now, what will now be, so that's my closing deferred tax. So what I mean by opening in the next year? So all you need to do is, for me to get opening deferred tax liability, okay, so in the first year, because this is my first year, okay, so to be new, all right, so next year, the closing for the first year will be the opening next year. So that's why you have 360 here, 240 here, and 120 here. So you're only bringing down this 360, you bring it there, this 240 here and that, okay? So you now do the net off so that you can know what you are charging or crediting to your profit or loss account. So mere performing that arithmetic, I will have negative here, okay? And that's what I post into my profit or loss as my current, as my deferred tax, okay? As my deferred tax. Remember, we have prepared our current tax here, if you remember. This is our current tax. That's the tax for that particular year, okay? Then we needed to compute the deferred tax effect, okay? So now doing that, I'll bring on my current tax as prepared up there. So these are our current tax. Then the deferred tax will now be 360, 120, 120, 120. And profit after tax, if you can see, it was stable throughout the year, unlike what we did earlier when it was declining. Okay, so that's the effect of deferred taxes. Okay, all right, so that's what happened in that particular scenario. Now, this is just to build or to make you to understand what happens around deferred tax and the effect on profit. Obviously, you don't see this in your exam. Okay, now let's look at example of temporary differences. You know, we said temporary differences will give rise to deferred taxes. So that's when there are differences between the kind amount of an asset and its tax base. You know, the kind amount can be higher than the tax base. What happened? That's deferred tax liability. And if the tax base is higher than the kind amount, that is deferred tax assets. Okay. Now, number one is when you now look at temporary differences, this can form a scenario question. You need to respond. Tax deduction on cost of non-current assets that have a different pattern to write-offs on the assets in the financial statement. It can give rise to temporary difference. Then pension liabilities that accrued in the financial statement were allowed for tax only when contributions are made into the pension fund at a later date. So pension liability is already accruing in my account. Remember when we done IAS 19, right? Oh, we've not done IAS 19, sorry. So we're going to do IAS 19 after now. You know, that's why I have to take deferred tax, you know, a little bit late because it affects some other standards, all right? But the issue around pension liability is, maybe if you still have time, I take it today. Now is, in a particular year, you are recognizing the movement in pension liability, even though I may not pay in that particular year. So when I pay, now the tax effect will be in the future, okay, at a later date. Then it will cause temporary differences. The intra-group profit on inventory that are unrealized in the individual account, there's a kind amount of inventory. By the time you are consolidating, it will be different, okay? And the profit elements on those inventory are also unrealized, and as such, because they are not because they are unrealized, and by the time you are consolidating, it gives rise to temporary difference as well. Then a loss that is reported in the financial statement and related tax relief is only available for carry forward against future profits. Remember, we needed to recognize the tax effect now, okay? Because those transactions occur now, even though we've not made profit to recover all those losses. Then assets that are revalued upward in the financial statement, but no adjustment has been made for tax purposes. So what it means is, if an asset is revalued upward, that revaluation gain is also subject to deferred tax, right? Okay, to also give rise to what's it called? Temporary difference. Then development costs are capitalized and amortized to profit or loss in future periods, but were deducted for tax purpose as incurred. Now, you remember when we did IAS 38, okay, development costs will be capitalized or amortized into the profit or loss in future periods, okay? Meanwhile, we are already charging tax because it's in our account as incurred, so it also gives rise to temporary difference. Then the cost of granting shares, share options to employees recognized in the profit or loss. Remember, when we did IFRS 2, you are recognizing liability or equity and expense, even though the shares will vest in the future, okay? But there is no tax deduction, right? So it also gives rise to temporary difference. So we're going to also look at that, okay? So how do I now calculate my temporary difference? How do we calculate our temporary difference? Now you have to listen here. So this is most likely what you're going to see in your exams, okay? Now, deferred tax is calculated by comparing the kind amount of an asset or liability to its tax base, right? And we already said that tax base is the amount attributed to an asset or a liability for tax purposes, all right? Now, in order to assist in determining the tax base of an asset or liability, IAS12 noted two things. One, it said the tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefit that will flow to an entity when it recovers a kind amount of the asset. Okay, so the tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic profit. Okay, against any taxable economic profit. For example, I sold on credit, revenue. I sold on credit. Okay, so for me to get a tax base, I have to look at the amount that will be tax deductible, for tax purposes against any economic benefit. Money will flow to me in the future. Okay, when I recover the kind amount of that particular asset. Okay, and of course, and if those economic benefits will not be taxable, the tax base of that asset will equal to the kind amount. However, if the economic benefits I'm expecting will not be taxable, that means the kind amount and tax base, they are the same. Then the tax base of a liability is its carrying amount, less any amount that will be deductible for tax purposes in future periods. Okay, so when I look at the tax base of a liability, if I want to know, I look at the kind amount of that liability, then I remove any amount that will be tax deductible for tax purposes in future periods. Then in the case of revenue, which is received in advance, tax base of the liability is its kind amount less any amount of revenue that will not be taxable in future periods. So the issue now is when you are looking at difference between the kind amount and the tax base of an asset or a liability, then you need to check that if the kind amount is higher than the tax base, so the temporary difference is said to be taxable temporary difference, which will give rise to deferred tax liability. So when I prepare my account under IFRS, if it is higher than the amount attributed by the taxman to that particular asset, okay, then it will give rise to taxable temporary difference, and that will be now lead to deferred tax liability. But the tax base, what the taxman has attributed to that particular asset, if it's higher than the kind amount, it is also temporary difference, okay? But it will be called deductible temporary difference and will give rise to deferred tax assets, okay? Once the tax base is higher than the kind amount, that is what we call deductible temporary difference and give rise to deferred tax assets. So you need to understand that. So for us to demonstrate this, let us look at a question. Okay, let us look at a question so that we can demonstrate our understanding. Now, we have these assets, we have the kind amount, we are going to determine the kind amount, we determine the tax base and the temporary difference. It's just different, my temporary difference is just different between my kind amount and my tax base. Is that okay? Now I said the machine costs 100,000, depreciation, let me pick my calculator, depreciation of 18,000 has been charged to date, tax allowance of 30 has been claimed, okay? So if I want to get a kind amount of this asset, everybody should be able to do that. I simply look at the cost and I remove depreciation. So if I say 100 minus 18, that should give me 82, right? Okay, so 82 is my kind amount, right? Now, for me to get the tax base, I look at the cost again, then I check what is the tax allowance. It says 30,000, okay. So I remove the tax allowance from 100, then I have, is that 70? Yes, I have 70. So what's the difference between 82 and 70? That will give me 12. So that is my temporary difference, okay. So that is that for the assets. Now, number 2, remember we're looking at kind amount and tax base. Interest receivable in the statement of financial position is $1,000. This interest will be taxed when received. So it will be taxed when received. So my interest receivable in the statement of financial position is 1,000. So that's the carrying amount, and it will be taxed when received. Okay. So since it's going to be taxed when received, so that means the tax base is 0. Okay. So I will now have my temporary difference will now be 1,000. Okay, I've not received it, so that means the tax base is nil. It's going to be 0. Okay, because to be taxed when received. Then trade receivables have a kind amount of $10,000. The revenue has already been included in the taxable profits. Okay, so trade receivables has a kind amount of 10,000. Then the revenue has already been included in my taxable profit. That means it's taxed already. Okay, so that means the kind amount is 10,000. Then the tax base is also 10,000. So I have new, what's it called? I have new difference, temporary difference. So let's look at inventory. Inventory has been written down by how much? 500 to 45 in the financial statement. The reduction is ignored for tax purposes. That means they've not taxed it. So that means the kind amount now is how much? 45, because that's been written down. Then the taxman will still be looking at that inventory at 5,000. And the difference will be the negative 500. Okay, it will be the negative 500. Now, liabilities. Current liabilities include accrued expenses of $1,000. This is deductible for tax on a cash paid basis. Okay, so it is deductible. So we have the current liability include accrued expenses of 1,000, and this is deductible on cash based basis. Okay, so it's when I receive that I pay. So since it's tax a cash basis, there's no accrual. So that means the kind amount is 1,000, then tax base is 0, then so that I can have a 1,000 because it's taxed on cash basis. Then accrued expenses have a kind amount of 5,000. Then the related expense has been deducted for tax purposes. Okay, so that means the kind amount is 5,000. Tax base is also 5,000 because the expense has been deducted for tax purposes so that I can have nil. Okay, so that I can have nil. So then also complete the table with the kind amount, tax base, and temporary difference. And I think you have done that, right? Okay, so you could see. So the non-current asset 82, 70, 12. Interest receivable. So let me look at the question. I can be. So interest receivable, it said in the question, it said interest receivable in the statement of financial position is 1,000. Can you see? That's a kind amount. And the interest will be taxed when received. Okay, so because I needed to tax it here, so that's why I have the what's it called, temporary difference. So the tax base will be new. Okay, now, so that's what we are saying. I think we still have to do something around that. So what you do normally, after you have gotten all your temporary differences, you now add them together. Whatever figure you have, that's what you apply, whatever rates, maybe 20%, 30%, as the question would have asked you. Okay, now, so let's look at recognition of deferred tax liabilities and deferred tax assets. Remember, deferred tax liability will be that the kind amount of an asset is higher than the tax base, all right? So that gives us taxable temporary difference. And when the tax base is higher than the kind amount, it gives us deductible temporary difference, which is also my deferred tax or deferred tax assets. Okay, so now AS12 says that deferred tax should be provided for all taxable temporary difference. So that's a rule. So when I have taxable temporary difference, I have to provide for them. When I have deductible temporary difference, which is also my deferred tax asset, I have to recognize them, okay? I provide for taxable temporary difference, which is my deferred tax liability. Is that okay? However, there are two things that may happen that will not make me to provide for them. For example, if it relates to goodwill, which will be amortized, okay? Because amortization is not tax deductible, okay? The initial recognition of an item that affects neither accounting profit or taxable profit, okay? So those two issues I will not provide for. So when I see goodwill itself, okay, that amortization is not tax deductible. So I don't provide for deferred tax effects. Then initial recognition of certain items that will not affect both profit, accounting profit, and what's it called, taxable profit. Now, when it comes to deferred tax assets, okay, it should be recognized on all deductible temporary difference. Remember, I recognize deferred tax assets. I provide for deferred tax liability. Okay, now, if all the exceptions about, for example, goodwill, initial recognition of those items that will not affect both accounting profit and taxable profit, then if there is insufficient taxable profit, okay, that are expected to be available for future periods against deductible temporary difference that can be utilized, then I don't need to recognize, okay? Now, let's look at measurement. I think on this measurement is regular. It's very regular. The examiner tries to bring it on now and then, especially in an explanation or just have to explain. Now, how do I measure? You know, measurement has to do with value. After I computed my temporary differences, which tax rate will I apply? That's what measurement is all about. Okay. Now, according to IAS12, the tax rate that is in force or expected to be in force when the asset is realized or the liability is settled should be applied on temporary difference to calculate the deferred tax balance. Okay. So let me say that again. The tax rate that is in force. So let's say in Nigeria, for example, tax rate is 30%, is already in force. That's what I apply. Or that is expected to be in force. So let's say, for example, I already have some transaction this year, all right? But I have not realized them. It will be realized in 2022, for example, right? And Nigerian government, probably by way of Finance Act, are saying tax rate will now be 25%. Okay, so the deferred tax that I'm computing will now have to be that 25% because I'm expecting that it's going to be enforced, especially if it's going to be substantive. Okay, so that's what that statement is saying. So let me take it again. The tax rate in force, okay, or is expected to be enforced when the asset is realized or the liability is settled. So obviously I may settle this liability in future. I may realize those assets in future. So if it's still 30%, that will be in force at that time. I apply 30%. Okay, should be applied to the temporary difference to calculate deferred tax balance. IAS12 now specifies that this rate must be based on legislation. Did you see that? Enacted or substantively enacted by the reporting date. Okay, so that's to be based on legislation. Is that okay? That's to be based on legislation. So we're going to see some practical, questions around here. How the examiner can decide to, twist some of those stuffs, and you could see what happens there. Now, remember that my deferred tax asset or liability will arise maybe in future and all of that. They are not discounted to present value. They are not discounted to present value. I think you have this somewhere there. Okay, yeah, here. Deferred tax assets and liabilities are not discounted to present value. So take note, in case, especially if you are taking ACCA exams, it says scenario, and the board are thinking of discounting deferred tax to present value, or deferred tax asset or deferred tax liability to present value, or they even already discounted using their WACC, weighted average cost of capital. Okay, then you have to write back to say IAS12 prohibits discounting of deferred tax liability or assets to present value. Okay, so please take note. Now, if an item gives rise to deferred tax, if an item giving rise to deferred tax is dealt with in the P&L, then the related tax effect or deferred tax should also be presented in the P&L. So what that means is, if I have an item that is giving rise to deferred tax, and normally that item is dealt with in my profit or loss account, so the related tax effect or deferred tax effect should also be dealt with in that same account. Okay. Now, if the item giving rise to deferred tax is dealt with in OCI, the related tax effect should also be recorded in OCI and held within equity. For example, revaluations. So we are coming there. So how do I present in my accounts? Remember, we have talked about recognition, measurement, then presentation. So how do you present deferred tax in your account? Okay. Now, deferred tax liabilities and the assets are presented as non-current in my statement of financial position. But sometimes you can decide to net them off. Okay. So I have my deferred tax liability, I have my deferred tax asset, I can decide to net it off, and I show the net position in my financial position. But I can only do that if two conditions are met. The entity has a legally enforceable right to set off current tax assets and current tax liability. Legally enforceable, maybe by courts. Maybe you and FRS are fighting already, so bring them to court, they take you to court, and they already ask you to do that. Okay. The deferred tax asset and liability relates to tax levied by the same tax authority. Okay, by the same. Sometimes in your account you have some of those items or taxes that goes to FRS, some to LIRS and all of that. What if it is levied by the same tax authority? So they might decide to, net it off. So let's look at question 2. We said required using the information in question 1. Can you remember? Calculate DIVE's deferred tax balance as at December 31, 2021. Remember, we got all this figure earlier. So you just net it off. You have 11,500. Then you now apply 30% because that's the tax rate, so that you can have your deferred tax liability. Why is it liability? You say that the asset whose kind amount are higher than their tax base is more than those other items whose tax base is higher than their kind amount. So that's why it is deferred tax liability. And my accounting treatment will be to debit tax expense in my POL and credit deferred tax liability in my account. Okay, so that's what you are doing there. That's quite straightforward. So let's look at another question here. Now here it said, explain which tax rate. Okay, remember, I told you earlier, you might likely see some of this in your paper. It said, explain which tax rate. And I remember measurement. Okay, it said the tax rate that is in force or that will be in force. That's what that is saying. But let's look at what they are saying here. BRIC is a company with a reporting date of 30th April 2024. The company obtains tax relief for research and development expenditure on cash basis. The recognition of a material development asset during the year, in accordance with IAS12, created a significant taxable temporary difference as at 30th April 20x4. The tax rate for companies at the reporting period was 22. Okay, sorry. Can I pick that? Okay, so it's 22 on 6th June 20x4 after the year end. Is that after the year end? Let me check the reporting date because they are very important. Okay, so this is my reporting date. Okay, now the government passed legislation to lower company tax rate to 20% from 1st January 20x5. Okay, so that's explain which tax rate should be used to calculate deferred tax liability for inclusion in the financial statement for the year ended 30th April 20x4. Okay, remember that recognition, measurement. Can you remember? Okay, or I should bring you back to that. Now, in that measurement, let me show you again so that you can apply it. I said the tax rate in force. In this question, was it? Let me see the question here. The tax rate in force is 22%. Yeah, you can see the question here. So that's 22%, or expected to be enforced when the asset is realized or liability is settled, should be applied to the temporary difference to calculate the deferred tax. Now, if you now look at this question, now it's telling us that the company obtained tax relief for research and development expenditure on cash basis. So that means it's realized this accounting year, cash basis. Okay, so even if there is going to be temporary difference, okay, in fact, you said the recognition of the material development assets during the year in accordance with IAS 38 created a significant taxable temporary difference as at the year end. Yeah, that's brilliant, but it's on cash basis. So that means it's already realized, or even if there's a liability that's already settled in this accounting year. So, and as at the end of the year, so which rate would I use 22% because it's already in force. 22% is in force. I'm not going to realize these assets in the future because it's on cash basis. So I cannot apply 20%. So that's what you tell the examiner. But let me find out what they have said here. It said deferred tax liability and asset should be measured using the tax rate expected to apply when the asset is realized. So the tax rate must have been enacted or substantively enacted by the end of the reporting period. So the government enacted 20% tax rate after the end of the reporting period. Therefore, it should not be used when calculating deferred tax liability, and it's the end. The current tax rate should be used. So per IAS10, that's the changes in tax rate is a non-adjusting event. So that's it. Okay. So let's now go to specific situations. So this is exactly what comes up around your group accounting, around your IFRS 2, IFRS 2, that you will see in your exams, okay, especially ACCA, okay. Now I have 4 specific situations, and I don't know how you're going to learn those 4, but you need to learn it because any of them will come out. I don't know which of them will come out. Okay, but most likely those that relates to group is going to come out, and the ones that relates to IFRS 2 is going to come out. Can I show you that? Group, deferred tax effect. So this is exactly what you're going to learn, and just try. I'll try so much to really explain. So there are 4. We're going to look at revaluations. We look at share option scheme. We have done IFRS 2. Okay. Then we look at unused tax losses. That's number 3. Then we look at business combinations. Under business combination, we're going to look at 3 things there. One, we look at fair value adjustments. We look at provisions for unrealized profits. Then we look at unremitted earnings. They don't really go around unremitted earnings. But under business combination, fair value adjustment is so key. Then provision for unrealized profit. So that's what I'm going to explain. Even if it's what we do today and we are fine, then I'll be glad. So tomorrow, we take IAS 19 very quickly. IAS 15, performance measurement. So next week, we are going to battle around financial instruments, cash flows, and foreign subsidiary. Okay, then IFRS for SME. I just pick out 1 or 2 things there, and you should be ready for the exam. Okay, so let's start with revaluations. When you revalue upward, naturally in accordance with IAS 16, you take the increase or surplus to OCI. So what's the standard that IAS 12 is now saying is that the deferred tax should be recognized on revaluation of property, plant, and equipment, even if you don't have intention to sell. So for ACCA candidate, listen to me, you may see a scenario to say they have revalued an asset and the board are contemplating on not recognizing the deferred tax effect on those revaluation because they don't have intention to sell. Then you have to tell them that they need to, because, that's what the standard has said. They have to revalue. They have to revalue and also recognize the deferred tax on those revaluation. It doesn't matter whether they are selling or not. Then even if any tax due on gain made on the sale of the asset can be deferred by being rolled over against the cost of replacing or replacement cost of a replacement asset. Okay, so it doesn't really matter. You just have to do that. Now, revaluation gains, normally are taken to OCI. So any deferred tax effect arising on that revaluation must also be recorded in other comprehensive income. Now, I told you earlier that if the item you are dealing with is in the profit or loss, then deferred tax should also be recorded in profit or loss. If it's in my OCI, then that deferred tax also goes to the OCI. So let's take a look at an example or to demonstrate deferred tax effect on my on this question. I think I might need to solve this question for you. Let me try and pick up my code so that I can probably connect to the white the board marker so that we can understand, because most likely this is where the examiner is going to pick you up from. This is not in FR, okay? Financial reporting. So this is now, okay, so let me, while that is loading, let me see the question. It said an entity, now I have a question here. Okay, I'll look for that later. An entity, Dodge, owns PPE that costs 100. Okay, it costs, how much is it? Okay, 100 when purchased. Okay, now depreciation of 40,000 has been charged up to the reporting date 31st December 2021. The entity has claimed a total capital allowance of 50. On 1st March 2021, the asset is revalued to 90. The tax rate is 30%. Required to explain deferred tax implication. Okay, let me see whether. So let's look at that. So what we are simply doing is to get the revaluation and take it to look at the deferred tax and take it to my OCI. Like, normally you take the revaluation gain to my OCI, then the deferred tax effect, I also take it to my OCI. So you have the solution there, but let me try and solve this for you. Let me see whether the board is ready. Yeah, I think so. Okay, I'm still loading. Okay, sorry about that. Okay, I think the board is ready. So let me see if I can pick up the board. So looking for the board. Okay, I think I'm there. Yeah. Okay, so let's, oh, where's my pen? Wow. Okay, I found the pen. Sorry. So what do I do here? Okay, let me try and look for the question here. Okay, okay, I think I've seen the question. Okay, so let me pick the pen again. Yeah. Sorry. Okay. Okay. So remember we are dealing with IAS12. Okay, and the question before us is Dodge. So it's asking us to look at explain the tax, the deferred tax implication of the situation. So here, he didn't tell me what they're actually dealing with, but from the question, I know this is revaluation, okay? Because on 31st March, on the second line, the asset is revalued to 90. And I already told you that IAS12 requires that deferred tax should be recognized on evaluation of property, plant, and equipment, even if I don't have intention to sell the assets, okay? Now, so if you want to solve this question to make life easier, just bring out the variables first. So let me do that for you. So I can say cost of this particular asset. From the question, it says 100. Okay, so then I can say depreciation. Okay, I just want to bring out the key issues here. I said depreciation. How much is that? Is that 40? Okay, 40. Then so if I do depreciation 40, then I think I can do something here. I can just get my carrying amount straight up. So this is my carrying amount. Abby? Yeah, that is my carrying amount. Okay. Now we were giving tax allowance. That's my capital allowance. So I can also bring that up. So I will say tax allowance. Okay, how much is that from the question? Is that 50? Okay, so that's 50. So that's tax allowance. Then what's the next thing I have there? Revalued amount. I also have it there. So I have revalued amount. Okay, how much is my revalued amount? Is that 90? Okay, so tax rates. What's my tax rates? Tax rates is from the question 30%. Okay, now, so therefore, I'll now say how much is my revalued amount? So I've already brought out the variables. So this is what I'm dealing with. Is that okay? So my revalued amount, which is my current amount, if you are very conversant with that, is I pick it from the question, is that 90? Okay, so you can see that from the question, and I've even written it on the, what's it called? Whatever. Now it gives me tax allowance of 50. Okay, tax allowance of 50. So if it gives me tax allowance of 50, so what will be my tax base? Is that okay? What will be my tax? That's actually my tax base, right? Now, because I needed to get my temporary difference. So my tax base will now be, sorry, where is it? 50, right? Okay. So 50. So the difference between my current amount, which is 90, and this will give me something like this. So it's going to give me 40, okay? Now, so this 40 is my temporary difference. Temporary difference. Okay, so this is my temporary difference. Now, I will now say tax at 30%. So if I apply 30% on that 40, what am I going to have? 30% on 40. Is that 12? Let me find out times 0.3. Yeah, that's 12. So this is my, so this is 12. So this is my deferred tax. Okay, but then, you know, before I revalue, let's take a look at that. Prior to revaluation. Prior to revaluation. Now, let's look at that. What was my carrying amount before I revalue? Carrying amount. Remember, this is my carrying amount before I revalue, 60. Okay, then what was my revaluation? So I can say revaluation because I needed to get that revaluation gain. Is that 90? Okay, so this is my revaluation. So this is my revaluation. So I can have a revaluation gain. That should be 30, right? Okay, so my revaluation gain is 30. So normally, I'll take this revaluation gain to my OCI, okay? So what would now be my, the deferred tax that is related to that revaluation? So I'll now say tax again at 30%, okay? So that 30%, that will be on that revaluation gain. So 30% of that, how much? 30%, 30%, 30, is that 9? So that should be 9, right? Okay, so I have this 9. Okay, now, so as I'm taking this 30 to my OCI, I'll also take the deferred tax effect to my OCI. So what will now be my, what's it called? Accounting treatment. So I'll go into my accounts. So let me try to see if I can do the double entry for you. Now the double entry, I will say, sorry, let me use it. I will say debit OCI That's the tax, deferred tax effect. 9,000. Okay. Then I will also, let me see. I'll credit, what will I credit? Deferred tax liability. Deferred tax liability. How much my deferred tax liability? Can you remember? So I have 12. Okay, so there's a balance of 3. Okay, because I have to get this, I have to get it balanced. Okay, so I'll now debit P or L with a balance. That's 3,000. Okay, and that's the end of that question. So this is what how it looks like. So in effect, okay, let me see. In effect, now if you notice, sorry, let me quickly explain this. So if you notice, this 9,000 goes to my OCI, and then this 30 also goes to my OCI, which relates to the revaluation. So effectively, by the time I charge the deferred tax here, and we have 21,000 left. Okay, because I have to apply the deferred tax effect on that revaluation, and that is what we have done. That is what we have done. So take a breather to look at that. So if it features as a whole question, or it forms part of a particular question in group accounting, so this is the trend, just follow. Okay, that's the trend we're going to follow. Let's even go and see whether what we have done is correct, but obviously it should be correct. Okay, sorry. Okay, so let me pick up the slide again. Okay, yeah, we got this 12, you remember? We got the 30, so 30% of 9, yeah, goes to my OCI in respect to the revaluation. Yeah, I think you got it right. Okay, so in effect, you have a balance of 31. Okay, so that's it. So that's what you are doing on revaluation. Now, you know, I told you we are dealing with 4 things, remember? The first thing is revaluation, share options, use tax losses, business combination, other business combination, look at fair value, then what's it called, fair value adjustment, and then provision for unrealized profit. Okay, so let's look at share options. Now, you know, in IFRS2, if you remember, when we did IFRS2, work for me for 5 years. At the end of the 5th year, I'll give you shares. It will vest or it will be exercised at the end of 5 years or 3 years, as the case may be. Meanwhile, every year, I am recognizing expense. If you remember, I will debit my expenses, credit my equity. If it is equity settled share-based payment, if it is cash settled share-based payment, I credit my liability. Is that okay? So the issue is the tax effect of those shares that will be due or that will be exercised in future period will be deferred, right? And I'm already recognizing the expense element now, okay? And remember that what the purpose of deferred taxes is to match the tax effect of those items in the current accounting period. So that's what we are trying to do here. Now, so let me look at what is in the story. Now, I said accounting for share option scheme involve recognizing annual remuneration expense. Did you see that? In my profit or loss throughout the vesting period. So tax relief is not normally granted until share options are exercised, which is in the future. Now, the amount of tax relief granted is based on intrinsic value. What's the meaning of intrinsic value? You are looking at the difference between the market value of shares and the exercise price. So at the end of the year or at the end of the vesting period, what is the market value? It could be 10. Then how much will I exercise? Those rights, it could be 8. So the difference between the two is what we call the intrinsic value. Okay, so and on that intrinsic value, that is where tax relief is granted. So this delayed tax relief, because it's going to happen at the end of the vesting period, means that Equity settled share-based payment give rise to deferred tax assets. Okay, equity settled share-based payment will give rise to deferred tax assets. Okay, and that is deductible temporary difference. Now, so in case you were given a question around that on share options, so you just have to use this pro forma to calculate it. You look at the current amount of share-based payment, which is usually nil. So you now remove the tax base of the share-based payment. Okay. Now, how do I compute the tax base of share-based payment? I simply use the intrinsic value. Okay. You know, normally my share-based payment, the way we computed it, remember, number of shares expected to vest multiplied by fair value multiplied by the timing ratio. But when I'm doing the tax base here, I will still do number of shares expected to vest. So instead of fair value, I'll now use the intrinsic value. What's the intrinsic value? I look at the market share of that share and the difference between the market share of the share and the, what's it called? Exercise price at that particular date. So I remove it so that I will now apply my tax rate to get my deferred tax asset. So the best way is to look at the question so that we can understand. But there's one more thing we need to learn here. Where the amount of the estimated future deduction exceed the accumulated expense. So whatever I get here is now higher than my normal computation remuneration expense, the way we have computed our tax base, okay? So it indicates that the tax deduction relates partly to expense and equity. So I need to split it between my expense and equity. So let's look at the question so that we can understand better. Now, an entity, Splash, establish its share, a share option scheme for its 4 directors. This scheme commenced on 1st July 2008. Each director is entitled to 25 shares options on condition that they remain with Splash for 4 years. From the date the scheme was introduced. Information regarding the options were this. So we're given a fair value at the grant date, exercise options. So now say the fair value of the shares on 30th June 2009. Okay, it was granted 1st July 2008. Then 20x June 20x9. That's just 1 year, okay? Now, a tax deduction is only given for share options when they are exercised. So tax relief will be given when they are exercised. So that means it will rise to deferred tax assets. Now, the allowable deduction will be based on intrinsic value of the options, assume a tax rate of 30%. Even if they didn't tell me that, then I will know, okay? So calculate the amount to be included in the financial statement for 2019, including explanation and calculation on and any deferred tax implication, okay? So all we need to do is to use this pro forma. I think I would also like to do that, right? So if I do this, I have to explain other ones because of time. So let me try to do this. Okay, so I have to clean the board, right? Okay, so let me try to do that. Let me find a question here. Okay. Yeah, brilliant. Sorry. Yeah. I have a line. So we are dealing with IAS12 specific scenarios. Okay. All right. So now let's calculate our what's it called? Liability, you know, the way we normally do under IAS2. Okay. So now my expense, you know, normally the way we normally compute our what's it called? Expense for the scheme. So we can say our expense for the scheme will be number. Should I still write all of that, or I should just say it? Number of shares expected to vest multiplied by fair value multiplied by timing ratio. Is that okay? So now, how do I get my number of shares expected to vest? It says it's giving directors 25 shares, 25,000 shares. It's giving 4 directors, remember? Okay. Then I multiply by fair value. So in the question, it said fair value of the option is 10. Can you see that in the question? Multiply by 10. We have done this before. That's IFRS 2. Okay. Then multiply by the timing ratio. So since I'm computing for 1 year and it's for 4 years, so it will be 1/4. Okay. So what do we have here? Then I pick up my calculator. So I'll say 25,000 times 4 times 10 divided by 4. So it's going to give me 250. Okay. It's going to give me 250. So normally, this 250, if you remember, I would have debited my expenses, credit my equity, because this is equity settled share-based payment. Now, but for the purpose of tax, right? If you look at that question, we're giving a tax relief, okay? And we'll be given a tax relief when it is exercised, and the tax rate is 30%. So tax relief will now be based on intrinsic value, okay? Tax relief will be based on intrinsic value. Okay, so what do we do here? So at the reporting date now, at the reporting date, date, okay? At the reporting date, the tax relief is that F, right? I think, yeah. The tax relief will be based on intrinsic. What's the spelling of intrinsic? Hey, okay, intrinsic value, okay, of the options. At the date they are exercised. Okay, at the date they are exercised. So what will now be my intrinsic value? You know, we said my intrinsic value would be what's it called? Fair value of the market price and the excise option. So therefore, it will now be, so if you look at the question, fair value is 17 naira. Okay. Sorry, did I say 17 naira? $17 minus excise option, which is that 5. So that gives me 12. Okay. So that gives me 12. So I will now do my deferred tax assets. So therefore, deferred tax assets is calculated as follows. Okay, so I will do my sign. So I will now say, remember that pro forma. You know, that pro forma is saying we look at the carrying amount of share-based, share-based payment. Okay, it will always be new. Okay, so it will always be dash. Now I will now look at my tax base of the share-based payment. So what is my tax base? Okay, now it is this same thing that I'm bringing here. So I'll say 25 shares multiplied by, so that's the tax base now, multiply by 4 directors, then multiply by, now instead of now using the grant date, which is this 10, I will now use the intrinsic value, which is 12. Remember, we have computed the intrinsic value here, then multiply by 1/4. Okay, so that's what we are doing there. Now, so I'll say 25,000 times 4 times 12, then divided by 4. So that gives me, I think that gives me something like this, 300. So I have this there. Okay, so if I do this, I'll still have this. Okay, so I'll now apply, is it tax rates? I will apply tax rates. Sorry, why is this one closing? Tax rate at 10. What's the tax rate in the question? Is that 30%? Okay, so if I apply that, I will have 30%, 300, that should be 90, right? So I have 90. Okay, I have 90. So that's what this is saying. So this 90 is my deferred tax asset. Deferred tax assets. Okay. So that's what it's saying. Now, the issue now is this. I said something earlier. To say that if my what I've computed here, which is this 300, is higher than the remuneration expense, which is 250. So what it means is that remuneration expense, part of it, and even my deferred tax asset here, part of it relates to the expense and equity. So you have to split it between the two of them. So you just have to split it between the two of them. So let me show you that. Now, sorry, let me pick up. Okay, so this is what we have just done. So can you see that? So that's what we have just done. Okay. Now, so this is splitting. So that 90 that we got, you debit deferred tax asset. Okay. Because an asset, so I debit it. Okay. Now, I will now split that 90 between equity and my expenses. Okay. So what goes to my equity? What goes to my equity? To be 30% of the difference between that 300 and 250, which is 50. Okay. And what goes to my expense? My original expense is 50. So I also apply 30% on it. So that's what goes to my expenses. So that's what was done here. So let me explain it again. That 90 that we got, you debit deferred tax asset. Now, why are we splitting between equity and expenses? Because the intrinsic value that we got, which is 300, is higher than the remuneration expense. Okay, IAS12 now says it should be splitted. Okay, it should be splitted between, that means the deferred tax asset has to be split between equity and expenses. So in my equity, it has to be the difference between that 300 and 250, which is 50. So I apply 30%. Okay, but for my expenses, remember remuneration expenses is 250. I apply 30% on that 250, so I can have this balance. So that's what we have done. Okay, so you go there to credit into account because it's deferred tax asset. So let's take a look at unused tax losses. Okay, now when there is an unused tax loss, that means you are making losses and you have not used it. That means you have not used to offset future profits. Okay, IAS12 allows a deferred tax asset to be recognized only to the extent that it will be probable that future taxable profit will be available against which those unused tax losses can be utilized. So you can only recognize the deferred tax asset if you are already forecasting that there will be profits that you can use to offset that particular losses. Okay. Now, in doing that, you need to consider whether the entity has sufficient taxable temporary difference against which unused tax losses can be offset, okay, or whether it is probable the entity will make taxable profit before the tax losses expire. I know you can't have losses forever, so you need to determine that, okay? And then the cause of the temporary losses can be identified and whether they are likely to recur. Otherwise, the existence of unused tax losses is strong evidence that future taxable profits may not be available, okay? And whether tax planning opportunities are available. So let's take a look at this question. Now, for unused tax losses, it's only a scenario question, okay? So most likely in the exam, you'll be asked whether they can recognize deferred tax assets. Now here it said, explain the deferred tax implication. So let's see. Now I said, at 31st December 2021, rest-time adjusted loss is 4 million, which arose from offsetting restructuring exercise. Under the law, tax law, this loss may be carried forward. So that means it's required by the law, okay, to release taxable profit in the future. Now, so since it can be carried forward, that means it can recognize deferred tax assets, okay? Now, RED has produced a forecast that predict total future taxable profit of 2.5 million. However, the accountant of record is not able to reliably forecast profit beyond that particular date. Now, the tax rate for the profit earned during 20X1 is 30%. However, the government passed legislation during the reporting period, lower the tax to 28%. So what do you tell the examiner here? So tell them that a deferred tax asset can be recognized if it is deemed probable that future taxable profit will be available against which those unused losses can be utilized, okay? And don't forget that the tax loss has to it has given birth to as a result of exceptional items, suggesting that the entity will return to profitability, okay? Now, since they can reliably forecast that they will make 2.5 million, they will return to profitability, okay? So that means it will limit the deferred tax asset that can be recognized, okay? And the tax rate, he said, the tax rate for the profits earned during the period is 30%, but they have passed a legislation in that particular accounting period and they lower it to 28. So that means they have to use 28% for that particular deferred tax asset they are trying to recognize. So you apply 28% on that 2.5 million so that you can recognize deferred tax asset that you can use to offset, what's it called? Unused tax losses, okay? So that is that. Then the last one here is business combination. So we have two things majorly that we are looking into here: fair value adjustment and of course unrealized profit. Okay, now I'm sure you understand how we do fair value adjustment. Remember, there's always a PP whose carrying amount is lower than the fair value. So you take it to the fair value. So when you revalue, just like we have seen earlier, but that is in individual accounts, that revaluation. But here, as a result of business combination, there will be differences between the current amount in the account of individual accounts and when they are consolidating. So the issue now is the deferred tax, has to be recognized on those different, okay, that are treated as part of net assets acquired. Now, goodwill is excluded. Goodwill itself does not give rise to deferred tax, don't forget, okay? Now, so let's look at this question. Now, I said on 30th June 20X1, Tom acquired 100% of shares of Jones for 300. At this date, the kind amount of the net assets was 250. Included in the net figure of inventory was 50, but with a replacement cost of 55. The applicable tax rate is 30%. Now, what is happening here? In the inventory, an individual account is actually 50, but replacement cost is 55. So it has given rise to temporary difference, all right? So I need to compute the deferred tax effect. So I simply apply 30% on that difference, which is 5, okay? So that I can recognize a deferred tax liability of 1.5 in my account. So what you normally do, the way you do your consideration, 300, the net asset acquired, can you see? Then the fair value uplift, that is the 50 to 55 replacement cost, okay? Then you now remove the deferred tax so that you can have this figure. So to now affect your goodwill. But don't forget, goodwill itself does not give rise to deferred tax. So that's what you are doing. So in case you have a group question where you were given or you were asked to compute the deferred tax, most of the group questions you've been seeing, they will just say ignore tax, ignore deferred tax. Once they give you the rates of deferred tax, so that fair value adjustment, okay, or the uplift you have done, just compute, just apply that particular rate and remove it, all right? So that is it. So it's quite straightforward. Then the last one is my unrealized profit. When there are intra-group trading, you are going to eliminate it. Is that okay? So when you are eliminating intra-group sales, then you are debiting cost of sales, then you credit your inventory in the consolidated account. But remember, those figures are still in the individual account. So it gives rise to differences in the current amount of those particular inventory. And remember, there's also provisions for unrealized profits, okay? Because unrealized profit has to be eliminated. So now that adjustment, by the time you debit your cost of sales and credit inventory, the adjustment will reduce the current amount of inventory in the consolidated account, but the tax base of the inventory remain in the cost in the individual account, okay? So to now create what we call a deductible temporary difference, giving rise to deferred tax assets, okay? Because the tax base will now be higher than the current amount in my consolidated account. So in that case, you need to recognize the deferred tax effect, which is deferred tax asset. So let's look at this question. Mog owned 80% ordinary shares of Glass for many years. During the current year, Mog sold inventory to Glass for $250, making a gross margin of 40. So I can say 40% of 250. Oh, that's 100, right? Wow, okay. So there's an 100. Now, 1/4 of this is still in inventory. 1/4. That should be 25%, right? Times 0.25. Okay, so I have 25,000 as my realized profit. Now say the tax rate is 20%. So what is the tax implication? So I already have 25 now. You know, this 25, I would have debited my cost of sales and credit my inventory. Then what's my tax rate? 20%. I apply 20% on that 25. So it gives me my deferred tax asset that I'm going to recognize. So what do? I debit deferred tax asset and I credit my tax expenses. And that's all. That's all. So it's about getting the realized profit, apply that particular rate, and then do your accounting entry. That is it. That is it. Okay. And that is all. Now, remitted earnings is quite straightforward. Nobody bothers you about that. It's just remitted. That talks about the kind amount of investment in subsidiary, associate, or joint venture, which will be different from their tax base. For example, if I buy a subsidiary, most likely the cost will be the cost of investment, or the current amount will be the cost of investment, okay? But in most cases, because of the share of profit, that would have increased the current amount from the tax base, okay? Probably because of unremitted earnings, okay? So this is just a matter of explanation. So at your leisure, you can just go through that. Okay, and that is it. That is it. Please take a look at that. So you also have your disclosure requirement. Then you have some questions here that you can practice at your leisure. The solutions are there. You just apply all those principles. But don't forget, I've tried to emphasize the fact that most likely you're going to see it as part of your group account. If you're writing ACCA in ICANN, you see it as a whole. I don't think they put it as part of group accounting. They will always test it separately, okay? And most likely all these questions will fly, you know, they are testing it separately. But for ACCA candidate, remember the measurement is very key. So they give you a scenario and ask you if they can recognize deferred tax liability and what will be the measurement, okay? And specific situations, you have revaluation, share option scheme, unused tax losses, business combination, where we look at fair value and provision for unrealized profit. So please take note of that. Thank you so much for staying with me tonight. We're going to see tomorrow, by God's grace, we'll go straight into IAS19, employee benefit. You don't have any question for me, but the truth of the matter is IAS12 is boring. So that's why in advanced audit and assurance, you won't see it there because it's boring, okay? And it's just computations, all right? So there's nothing really interesting in that. All right, so thank you so much, but it's quite interesting. Okay, I'll see you tomorrow by God's grace. Have a very wonderful night rest. Good night.